Welcome back to the Property Buyble. My name is Kim Ackerman. I'm a buyer's agent from Trelease Associates in Sydney. Now, today is not your average episode on the Property Buyble. We are actually now in season 2 of the show. Now, this season, we're going to be talking about all things investment property. We're going to have data scientists, mortgage brokers, renovation specialists, anyone that has anything to do with property investing, we're going to be chatting to and giving lots of great insight into the investment world. Now, today, to kickstart off this season, we're going to be talking to a mortgage broker with a lot of years experience in the industry. So we're going to be talking about why your investment loan should differ from your home loan. And to help discuss that topic, I have Adam Rakowski from Ortus Financial. Welcome, Adam.
Thank you. Great to be here.
Now, Adam, this topic is a really good one to start off with. I think you have 15 years plus experience in the industry, so you're a great person to be able to discuss this topic with. You know, just to give people some background, you're an ex-banker.
That's right. Yeah, 15 years at Macquarie Bank.
Bank.
Straight from uni.
And now you've got your own company, Ortus Financial in Sydney.
Yeah, look, Macquarie is a great place to work, but I think ultimately, you had your own product to sell, and,
Yes.
and as a broker, you have the whole market, and I think that is very important.
Yeah, for sure. Well, you were a finance broker, or some people like to call it mortgage broker, but you're also the principal and founder for Ortus Financial. You've helped a lot of my clients in the past, and you continue to do so, and we continue to work together. But I think one of the reasons I wanted to bring this topic to light and really kick this off is when people go and they start to look to buy investment property, the finance side of things is really that first step in a lot of respects. And that's when you sort of come into play. So, you know, when we start building an investment property, we need to get a mortgage for that investment property. What a lot of people don't realize is there are things that differ in your investment mortgage, or things that you should put in place differently than perhaps your home loan, for example. Would you say?
Definitely. And I think people tend to default to their home loan provider, which can be limiting. I think that the options out there are limitless, and I think having an understanding of those options is very important.
It is. And it's about planning ahead, you know, putting those things in place, because everybody has different situations.
Correct.
And if they don't plan ahead for building this portfolio that a lot of people are trying to build, especially from the beginning, they may end up in a sticky situation where something is not flexible enough, or they may not be able to, you know, go to that second or third investment property because their first mortgage wasn't set up correctly, for example. Do you have a lot of clients like that go through that process, not realizing there's less flexibility on their mortgage?
Yeah, it's a very common situation, and I think having an understanding of the basic difference is critical.
Yeah.
And I think, you know, a home loan and an investment loan, it is what it sounds like.
Yeah.
But at the same time, you've got to understand that sort of the nuances there.
Yeah.
You know, home loan is for a home that you're going to live in.
Yep.
An investment loan is for, you know, an investment property or shares, for example. But they're very different, and the banks look at them a bit differently. So having an understanding of how they're different is very important.
I guess to kickstart things off, when we talk about loan usages for investors that are getting pre-approvals for this next property, or for their first property even, what are we talking about when we talk about loan usages?
Look, it's all about purpose. So if you're using the money to buy a home to live in, or to renovate a home that you live in, it's a home loan effectively. If that loan is to be used to buy an investment property or buy shares, it's an investment loan.
Okay.
And I think that's a common misconception. People often think, my home is actually providing the collateral for the loan, therefore it's a home loan. But no, you know, you can have a home loan in place and then say to the bank, I actually want to borrow money to buy a new property as an investment. And that purpose is investment, therefore that loan is an investment loan.
Okay. And one of the things that I don't even know if we're going to have time to talk about today is how to structure those loans when you do start to get your second and third and fourth property. If you are borrowing money from one loan or from one home to buy an investment, and then borrowing money from that investment to buy your next investment, it can get quite complicated. So having someone like yourself as a broker can help you structure that in the most financially efficient way possible.
Agree. And look, I'll touch on that later, but I think you're right. People often look at the current situation and focus on that, and don't look into the future.
Yeah.
And I think with the investment market, there's a disparity in lenders. So if you don't look to the future and what a policy might be, you can actually put yourself in a bad situation down the track.
Yeah.
So again, knowing the basic differences between the two is helpful.
Yes.
And things like serviceability, for example. Obviously, when you buy an investment property, you will get rental income.
Yes.
But it isn't that simple. So, for example, the bank will take that income and go, okay, we'll take 80% of that income, for example, not 100%.
Yep.
And on the other side, the interest rate you pay might be buffered. So whilst as the client, as the borrower, you might be able to work out that you've got more rent coming in and you're paying interest.
Yep.
When the bank looks at that equation, it might be that they actually think
They're very conservative, aren't they?
That's right.
Yeah, and every bank's different. Every bank has different policies and so forth. And
exactly.
That's why I love brokers so much, really, because you guys know what are the different policies for the different banks and what is going to be the best kind of policy for that particular client, just as an example.
Correct.
But I guess that rolls us into the different types of rates. We talk a lot about variable and fixed rates on the property Buyble. It's been mentioned a lot in the fundamentals of those things. But when we're talking about building a property portfolio, building an investment portfolio, there's different things that are going to affect different people. What are the different rates, different types of rates that we have available?
Yeah, so there's obviously variable rate and a fixed rate.
Yes.
And it's again
what it
simple
says.
in many ways, but
Yes.
again, knowing the nuances is critical. And I think with investment lending, to sort of be clear, it is deemed riskier than home loans.
Yep.
Because you're sort of relying on rental income to service the loan. So as a result, your rate will be higher than a home loan rate. But a variable rate is essentially a floating rate. So the day you take out the loan, that rate can move up and down depending on what the Reserve Bank is doing with the cash rate.
Yep.
And the fixed rate is the opposite. So on the day you settle, you are agreeing to a certain rate for a period of 1 to 5 years generally. And over that period of the fixed term, your repayment or your rate won't change.
Okay.
So it can be good for people who'd like to know what their rate will be.
Yep.
But of course, people try to pick the market or what's higher or lower. That sort of isn't the point.
No.
But again, it's very topical because at the moment there's been a huge amount of press around rates and what's going to happen. I think people are having this internal battle around what to do.
Yeah, no, they definitely are. A lot of buyers they ask us, as if we have a crystal ball. I wish that we did. But not knowing what's going to happen with the rates is one thing. There are always, I did an interview on the weekend and they asked me a very similar question. And I said, there's always going to be something. If it's not interest rates, it's COVID. If it's not COVID, it's negative gearing. If it's not negative gearing, it's something else. And it's just like there will always be risks involved when you're investing, not just in property and in any type of investment really. But look, as we jump back into this rate type, for example, I think it's good for people to have a plan to know, what's your timeline? I mean, I'm sure you get clients come to you and sort of say, we want to buy 3 properties by the end of this year, or we want to buy 1 and hold it and then maybe get our next one in a couple of years' time because we have, the risk kind of gives us anxiety or anything like that. So these different types of rates are going to be suitable for different people. Is that correct?
Definitely. And so as I mentioned, with the variable rate, so at the moment, an investment variable rate 2.5% to 3.5%, depending on which lender you have. Yeah. And I often see some pretty crazy variance. So it does vary quite a lot. And on the fixed rate side, like I said, it's changed a lot in the last month or two, but at the moment between low 3s to up to 5%.
Yeah, right.
So again, having a view on how that affects.
That's a massive difference.
Yeah, huge. It's huge.
That's huge.
It's really now hard. You can't try and pick the rate. I think like I said, you need to consider your own situation and let that be the guiding principle around it. But you mentioned the biggest factor, which I think not enough borrowers or even brokers or banks look at, is they focus on the transaction at hand and not
the big picture.
Exactly right. Because having a view to that big picture will determine which bank to go with potentially. Probably the biggest thing on that would be flexibility to your point. So obviously if you've got if you've been in the market for a while and you've been fortunate with the movement on price, people have equity in their properties.
Yeah.
And the most common, I guess, strategy that we see is people will take that property, have it revalued,
Yep.
and then look to use that equity to buy another property.
Yeah.
Now, this is a really key point because the banks have a huge different policy on this situation. Some banks will say to you, okay, no matter how strong your actual position might be income-wise, we will limit you to, say, $250,000 on that equity release, which obviously is hard to buy in Sydney, for example, if that's going to be your 20%.
Yep.
Other banks have an unlimited rule. So they'll say to you, as long as you can show to me that you can afford that loan,
Yep.
it can be $1 million.
Yeah, wow.
So again, if you put someone into a loan or recommend a loan that is the cheapest rate, for example, but you know they're going to want to buy a property in Paddington in a year, well, having a limitation of 250 grand won't make that possible. So again, you've got to be very clear and careful to consider that implication around the flexibility.
Yes. And that's the thing, going with a fixed rate, although you have the peace of mind of fixing the rate, you don't have the flexibility if you do want to buy another property and that first property that you bought goes up in value and you want to pull out that equity, as you just mentioned then, to buy another one. If you're in a fixed rate, you may not necessarily be able to pull that out, not because it's not available, but because the structure of the mortgage does not allow you to.
Correct. Exactly right.
Case. So that's really important for people to know when they're starting this journey, I guess.
It is. So a fixed rate does anchor you.
Yep.
To a degree, and it can work out in your favour. But I guess knowing the downside is important. Again, with a fixed rate, you are locked in, so to speak, for the term of that fix. If your circumstances change,
Yep.
you can't then automatically leave.
Yeah.
Or you can, but you'll pay a break fee.
Yep.
And the problem with that break fee is it's very opaque. You're not given a calculator to say to you, dear Mr. and Mrs. Borrower, this is what you'll pay. You get told what the break fee is, and you kind of have to accept it.
Yeah.
So it's not an amazing process, having been through it myself.
Yeah.
So you need to, I guess, again, really carefully consider, is this bank the best for me for this property and also for my second and third and fourth property?
Yeah.
You are locked in, or you pay a big fee potentially.
Right. And I guess people should just be aware that whether you are choosing a fixed or variable for your investment property, to understand what are the pros and cons of both of those things, because both of them work. You can have a fixed or variable for an investment property or for a home loan in that case. But tie it back to your timeline, how soon you might need to pull that equity out if you're looking to build quite quickly that portfolio. And then there are other things attached to it. For example, a lot of fixed rates don't allow you to have an offset account, which is a whole nother conversation that we could have.
Correct. Yeah. So good point. So, if people often will take equity release but not have a property in mind, they might have a buyer's agent.
Yes.
So they might do the release first.
Yep.
And then wait up to a year to buy potentially. So, again, some banks do offer offset for fixed. So that could be a better option for someone who's going to wait. So take the equity release, for example, while they can do it, park it in an offset account, and then act when they need to.
Okay.
And again, if you have that plan, that roadmap in mind, you can make that decision there and then. But you're right, most lenders don't offer that functionality.
Yep.
So again, it's all about having a broad understanding of the different options and not just focusing on that one particular thing. And often that is price and rate, because people love to save money, understandably, but at the same time, having a bigger picture again is the most important thing in my opinion.
I agree. I completely agree with you. And this is not something that we discussed beforehand, but having the equity release that we're talking about, and this is a whole nother topic, but just to touch on this a little bit more with you, Adam, having the equity release, just because you've got equity in a property, not all banks allow you to just pull that out. Even if you do service, if you don't have a property to put it on right away, some actually hold that back. Correct. Or they don't just let you pull it out for cash just because you might go spend it and go to the casino or do something crazy. So there are policies for different banks around the actual release of it as well, isn't there?
There are, and the reason why that's important in my opinion is that what you'll often see is banks will also limit you to where you can buy. So some banks might be overexposed to a certain area.
Yeah.
So it might not be that area is not good, but it could be they already have too many loans in that building or in that suburb. Yeah. So if you're, I guess, conditionally approved, i.e. the money isn't with you, and you then agree to a contract unconditionally to buy, you go to your bank to convert that loan and they say, oh, sorry, Chatswood's no good for us.
Yep. We don't want to give you that
No,
extra.
so I think, again, understanding which bank will hold the money back until you show them what you're going to buy versus which bank will say, look, we're comfortable with the situation, have the money, and then you can act obviously much quicker and with confidence, which ultimately is the most important thing in any market. You want to be able to act quickly and as a buyer's agent, giving you sort of more tools to negotiate.
I think the next thing we need to talk about is the principal and interest, or the interest only, which is something for people to explore. So could you tell us a little bit more about that?
Sure. Look, I'm not a financial advisor, but I think you do see people almost default to having interest only when they're buying an investment.
All right.
And in a basic sense, if you negatively gear your property, if you sort of pay more interest than you're getting back in rent, there is a taxation benefit to you potentially depending on your situation. So I think people in their mind just think they have to go that way. But there are, again, ramifications potentially to understand. So that's, again, not just blindly going into something, not knowing what could be the outcome if you don't.
Of course. I actually had this conversation with a colleague of mine this morning, and we were talking about the interest only side of things. And a lot of people, it's a psychological barrier to think about getting an interest only bank loan, and it's only for a short period, isn't it?
Yeah. So again, and it's funny. So either way, it's a 30-year loan typically. Okay. But you're right. For a P&I loan, principal and interest, you are repaying an equal proportion. So your repayment won't change over 30 years, assuming the rates don't change.
The ratio changes.
Correct. That's right.
Okay.
So you are creating equity as you go. Which could be important if you're an investor who, for example, wants to buy properties 2, 3, or 4. It could be that you want to create equity from day one and not rely on the market moving up in your favour. So, but I think more people will go to interest only, where. And you're right, it's a 1 to 5 years you can do. So it'll be a 30-year loan. But for the first, say, 5 years, you'll only pay the interest back. Which can, again, help you because it'll create potentially a loss in an investment sense, which could then help you from a taxation point of view. But again, having the simple, in that sense, you are actually then cash flowing that loss yourself. So, and people often also don't understand that whilst as a borrower, if you're paying interest only, your repayments are lower month to month. When the bank works out what you can afford to borrow, it's actually worse. So with the P&I loan over 30 years, it's pretty simple. It's a straight sort of repayment. Let's say you do 5 years interest only, and then you've got 25 years P&I. So put simply, the bank's then assessing you over 25-year repayment, not 30. So it's actually like a shortened timeline to repay, therefore more each month. People actually don't understand that whilst it's helping you month to month, it's actually... you can borrow less if you go interest only than P&I from the bank's point of view.
Well, you can do the borrowing, potentially change it down the track. But a lot of the time, well, in my, what I've seen, and I'd love to get your input on that, if people are changing from principal and interest to interest only, sometimes you have to do like a full-blown brand new assessment, like getting a brand new mortgage when you're changing over. Is that right?
Exactly.
It's not just like a quick type up on the keyboard on your profile. It's a full-blown another assessment in a lot of cases. Look, there's a lot there, but I think I just wanted to talk about that because a lot of people, when we are building these investment portfolios, cash flow is key. You don't want to get so many negatively geared properties that don't have strong enough cash flow to cover the repayments and then be, pocketing out money every month to repay your expenses on all these investment loans. So swapping over to interest only, I see a lot of investors do it. This is very general advice, everyone. This is not for everybody, but it's something to explore. It relieves the cash flow situation, allows you to only have to pay the investment side of things. And then in some cases, some investors that I know, including myself, they still put aside the full amount of the principal and interest payment, but the principal portion they dump into their offset account.
Correct.
Which is another idea for people to consider. Do you have some clients that do that?
I do. And again, to your point, I think the key thing to understand here, the key point is that if you opt for P&I on day one, to move to interest only does require a full assessment. So as a broker, I'll ask you, Kim, pay slips, bank statements, all again. If you are interest only from the start, and you want to then go to P&I, you tick a box and sign a form.
Have you ever been in a situation where an investor is on principal and interest and then they want to move over to interest only, which is obviously going to make them more serviceable from a repayments perspective, but because there's a bigger risk there for the bank, they don't service from a borrowing perspective?
Definitely, yeah.
Yeah? Does that happen?
Yeah, look,
does that make sense?
It does. It
Yeah.
often happens where a client might have an element of their income that's discretionary, like a bonus or commission. So when the loan was taken out, they had a bonus, a high bonus, and it was approved that way. And then they go back and want to change it, and then for whatever reason, COVID or whatnot, the bonus isn't as good and the capacity drops, the bank will say no.
And the other thing to think about is when that interest only period expires, your repayments will adjust back to principal and interest. And depending on whether, if you're on variable or fixed or whatever that situation, because that's a whole nother section of the interest rates, is they will readjust. And it's almost like the last part of that 30-year mortgage is readjusted to those new repayments to be able to pay off the rest of it, including the principal portion.
And like I mentioned, that repayment amount at that point will be higher than what it would have been had you gone P&I from day one.
Yeah.
And people also don't understand, you can't just roll that for another. So if you have a 5-year period up front, banks generally won't then allow you to go another 5 years.
Yep.
So people often don't understand that they can't just roll it and aren't prepared again from a budget point of view to then. So again, having a broker, for example, who can warn you 1 year out, just to remind you that in a year's time your payments are going to go to X.
Yep.
And then working through that and what that means for them is obviously very important.
Okay. And I guess one of the last big ticket items I wanted to discuss was LMI, Lender's Mortgage Insurance.
Yes.
Can you, and we talk about this a lot on the Property Buyble, but can you please give people an understanding of what is Lender's Mortgage Insurance and how it could potentially be beneficial for an investor building their portfolio?
Sure. Yeah. So LMI is essentially an insurance policy that is taken out by the by the lender, the bank, but paid for by the borrower. So the policy itself protects the bank. And typically, if you're borrowing more than 80% of the value of the property, whether it's a home or an investment, there'll be an LMI factor. Now, there are some professions where you can avoid that if you're a doctor or a lawyer, but for most of us, we have to consider paying LMI.
Us regular people.
That's right, us. And I think that understanding the implications are important. So it's there to protect the bank, not you.
Yeah.
But you pay
we
for
have
it.
To pay
you
for
pay
it.
for it.
It allows us to borrow more, though.
It does, yeah. So look, the biggest benefit to an investor, again, is that if the market's running a certain way and saving money is always difficult, you can buy with a 10% deposit rather than 20. Now, with investment lending, different to so with home lending, you can have as little as 5% potentially. With investment lending, it's riskier, like I mentioned earlier. So 10% is generally the minimum. But again, it might mean you can buy tomorrow rather than waiting until next year, and that could help you. So there is a big benefit to it. But again, considering how that plays out for you is important. You're given the option to pay that LMI yourself on day one, or you can actually add it to the loan. Yeah,
to the debt of the loan. Debt. And it's usually just like a flat fee, isn't it?
Yeah, again, it's like a sort of calculation that there's two providers in the market. There's QBE and Genworth, and they kind of just say this is the number, and you essentially just
pay it,
accept it.
Yeah.
But I think too many people just capitalise it to their loan out of that's what you meant to do. But in the example of say a $10,000 LMI cost, say you're paying 4%. So that's $400 a year. Oh yeah, not too bad. But when you consider that then is a 30-year loan, and you're paying that every year, all of a sudden you're paying the $10,000 LMI plus the difference. So it's not as simple. I think people should give more thought to paying that on the day potentially, rather than just simply blindly capitalising it to it.
And this is the thing, even if we don't keep that loan for 30 years, which not a lot of people do, especially when you're building an investment portfolio, you still got to pay 30 years worth of LMI in one hit on the debt of the loan. Is that correct?
Well, it's more that if it's not as simple as it's not a one-off cost.
Yeah.
As your loans higher than it otherwise would have been. Therefore,
Yes.
the ongoing interest is going to be higher. Whereas people tend
Right.
to... So
I understand what you're saying.
Yeah. So again, it is a one-off cost.
Yes.
But at the same time...
It increases your debt though, so it increases
does.
your interest.
Exactly right.
Yeah, so it's so much more than just the fee itself.
Correct.
You're also paying interest on the fee.
Exactly right.
Yeah, and a lot of people don't think about it
No,
that way.
not at all.
So, yeah, it's such a good thing to take into consideration. But I guess on the flip side, if your investment plans are going to outgrow those fees and you're going to, the plans you have in place are going to make more money on, getting the next property and the next property and the next property by only paying 10% deposit up front, maybe it's worth it in some cases.
Definitely. Yeah. So
that's why people, a lot of people do it.
And again, like you're right, it's a personal thing, and it does help people get into the market earlier. There's no doubt about it. So there's a place for it, no doubt.
Yeah.
But again, it's just something to consider all the ramifications, not just as simple as
get it
and move on.
No, not at all.
Yeah.
It's just an option.
Correct.
But anyway, okay. Before we go, I really want to give people just some short, sharp tips on what they can do, taking away everything from this episode that we've given today. So I guess one of the biggest things is put a plan in place. It doesn't mean you have to know what you are doing for the next 50 years or 30 years, but have a bit of an idea of, a 5 or 10 year plan. You don't have to be working with a financial planner, but if you are, even better. Work out a plan, and then that will help you to work out what kind of mortgage structures you should be looking at signing up to as well. I guess the next thing is to be aware of the various types of loan usages. If it's an investment property, the bank likes to know that it's an investment property because they will pull in the rent and use that towards your serviceability. If it's a home loan, you may have better rates on the home loan,
Correct.
But then you're not going to have the serviceability from the rental. So it's a double-edged sword, but there are pros and cons of everything. The next thing is to look at fixed and variable options and how those will tie in with your timeline of your property building, your portfolio building that you're doing. And the last one is to consider using LMI, Lender's Mortgage Insurance, to boost that investment timeline if it's right for you, if it's right for your risk profile, if you're eligible for it through the bank, and if it makes sense from a monetary perspective as well, long term. So hopefully that was helpful. Thank you so much
Pleasure.
for coming in. I understand we've popped your podcast cherry today. This is your first podcast, so I'm very honoured to have you a part of this.
Thank you.
And the first episode for this investment series that we're doing. So I think this was super helpful, Adam. I absolutely adore you. I always love sending my clients to you as well because you're just fantastic at what you do. So thank you so much for your
Pleasure.
time.
Thank you.
Hopefully that was helpful. Everybody, take away from it what you must. Still go to a professional every time. Speak to a mortgage broker or your bank or a lending specialist, whoever is within your realm. If you want any referrals, obviously we've got a great man here to help you through that process. But learn about this. It's just going to help you when you're building your investment portfolio. And we'll see you for the next episode.